Hello, from LPL Financial. Welcome to The Talking Point. I'm your host, Quincy Krosby.
Good morning, everyone. This is Quincy Krosby. This is The Talking Point. It is Monday morning, October 28th. And as I record this call, the futures market is up. When we're looking for the earnings, I want to point out that there has been a little bit of disappointment in the earnings expectations. They've come down just a touch. This week is going to set the tone, really, I think, for the rest of the earnings season, because this week is probably the heaviest of the earnings season. We're going to have a tremendous number of companies, over 120 companies for the S&P 500 reporting this week. But the market is very much focused on, yes, you know which ones I'm talking about. It is the MegaTech names. It will be Apple, it'll be Microsoft, it'll be Amazon, it'll be Alphabet, it'll be Meta. About approximately $12 trillion in market cap, which actually comes out to approximately 23.2% of the S&P 500. So far, the expectations are that we will have positive reports, and most importantly, guidance will be solid enough for the market to basically, say that these are good reports. Because remember, in the second quarter earnings season, it was quite disappointing for a number of the names. The market, punished those companies in big tech that didn't talk about the integration of the AI infrastructure that it was buying. I mean, let's face it, the amount of money that was spent in the second quarter is estimated to have been, for all of big tech, approximately $60 billion. And the spending is continuing, especially if you listen to what NVIDIA has to say, that the orders are in for their next chip. Now, by the way, we won't hear from NVIDIA until the end of the reporting cycle. So we'll have to keep that in mind. They always come in at the very, very end. But again, guidance is going to be crucial, and the market will be discerning. There's no doubt about that. But remember how the market was surprised by Tesla. Remember, Tesla is part of Magnificent Seven, although they were kind of pushed out a little bit, but they came in and the guidance was extremely strong. The earnings were good, the revenue not so great, but the expectations and guidance helped propel that share price and a halo effect on the rest of tech. So we're going to see if whether or not we get a homogeneous reporting out of big tech this week. Also, keep in mind, we've got other names coming in that will be important. I'm going to be paying attention to Caterpillar. Why? Caterpillar, to me, is very much associated with infrastructure, and not just infrastructure in the U.S., but infrastructure globally, particularly in the Middle East. I want to hear what that company has to say about infrastructure here, about infrastructure outside of the country. We're also going to hear from ExxonMobil and Chevron. Why are these important? We know why they're important. We want to see if they're going to continue to deliver shareholder value, despite the fact that oil prices are coming down. And I'll get to that in a minute. We'll hear from McDonald's, and obviously we want to hear what they have to say regarding the Big Mac and the onion issue. I've just read that the Big Macs are coming back in. They've tested negative, and that was about the meat. I don't know if those onions are going back on, but how can you have a Big Mac without the onions and the pickles and the ketchup and the mustard? I like that whole combination. But in any event, we'll hear what they have to say, and then we'll hear from Pfizer as well. So, I mean, this is going to be a very, very big week for the earnings season. And again, because we started to see a little bit of a slowdown in the earnings coming in from last week, we want to see if this week's earnings actually can pick up the step. But more importantly, I can't repeat this enough. It is about guidance, guidance, guidance. That's what we want to hear. This week also, tremendous amount of data and important data. We're going to have the payroll report at the end of the week. Now, keep in mind, this is probably going to be reflective of the Boeing strike, which is ongoing, but obviously it's been going on for a number of weeks, and also the hurricanes. So we're going to have to basically navigate around those numbers. Nonetheless, there'll be some important data, what the work week is. Remember, from the last report, please keep this in mind. The work week was weaker than you would expect, with a gross domestic product in this country that is actually very, I wouldn't get carried away. I wouldn't say it was stellar, but it certainly is strong. It's solid and it's strong. You would think that the work week would be a bit longer, but it wasn't. And we have our eye on that. And we'll see, obviously that's going to be, we have to see what they have to say about the hurricane and Boeing and so on. The analysts will be ripping apart all of these numbers. But we're going to have that. But we're also going to have the Fed's preferred measure of inflation. And everyone knows what that is by now. It is the Personal Consumption Expenditures Index, the PCE. And what you want to see is, are we seeing inflation across the board from core and so on? Remember, they break it down, coming down at a faster clip that will assuage fears that inflation is getting sticky and not coming down as quickly as the market wants. Right now, by the way, there's a 95% probability at the Fed's next meeting right after the election that it will be a 25 basis point rate cut. But I will point out that if the Fed is worried about the labor market and feels that inflation is coming down at a faster clip, the Fed could come in with 50 basis points. Right now, that is not on the horizon, and the Fed funds futures market is not suggesting it. But keep in mind, the Fed is very much focused on the labor market and the health of the labor market, and has, in many of the commentaries that we've heard, the Fed has talked about they do not want to see any deterioration or any more cooling in the labor market. So again, we're going to have to work with the data that we have, and the unemployment rate had come down to 4.1%. We have to keep our eye on that. And again, factor in the Boeing strike, factor in also the effect from the hurricanes. All prices are down. They're down below $70 a barrel in West Texas Intermediate crude. That's the U.S. benchmark. Why? Couple of reasons. A little bit of hope in the Middle East. The Israeli retaliation was very measured, extraordinarily measured, making sure it just hit certain targets that were not going to affect the population, was not going to affect the energy complex, and so on. And in addition to that, the Iranians haven't been, other than domestically talking about retaliation, have been fairly quiet. And we've seen this before between Iran and Israel. Okay, now we've hit you, you've hit me, I've hit you, let's be quiet about it. Let's see where this goes, because right now, according to many of the reports, there is intense diplomatic lobbying in Doha, where, by the way, they've been very much involved throughout the Middle East crisis and trying to come up with a ceasefire and also the return of the remaining hostages. That's part of the package, according to the chatter that we are hearing about in the media. So this is going to be important, because if that becomes, and the market believes it's contained, and we're going to have a pause, oil prices should continue to come down as demand comes down. Now, I do want to point out, though, if the winter looks as if it's going to be very cold, particularly in the Northeast where oil is used, oil prices could start inching higher. So all of this is reflected, though, today as oil prices have pulled back, because of the sense that we may see, again, a contained Middle East crisis, and that's important, and that Iran and Israel take a break, a pause, and then perhaps in terms of Gaza, we get a return of the hostages and Israel agrees to a ceasefire. So a lot going on there. In terms of, we've got to get over there to Russia and also the Ukraine, there's a bit of a concern, more of a bit of a concern, I would say, actually, is that North Korea has sent in troops to now fight with the Russian troops against Ukraine. So all of this causing a bit of alarm. And interestingly, and not so interestingly, you follow it, China is not exactly pleased by this because, again, what will happen is the North Koreans will basically turn around and say, okay, now what can you do for me in terms of trade and so on? We know that North Korea, by the way, has been supplying Russia with military components and with advanced electronics in terms of the military arsenal. So all of this, again, amid a backdrop of, yes, the election. And so I just want to point out as well, the 10-year Treasury yield had pulled back, but now we're seeing it inch higher. There are those who say that the yield moving higher is more associated with the probability of a Trump victory. Many say that because what will happen is if he got all the tariffs that he wanted, all of the taxes that he's talking about, and he's mentioned perhaps doing away with taxes and introducing something else, maybe a value-added tax and so on. But the point is there's a group that believes that that move higher in the yields is associated with a Trump victory, although you could argue that the better economic data also suggests that the 10-year yield would be moving higher in a what shall I say, healthy way. We'll have an idea because we'll have a read on the GDP for the third quarter. It'll be an initial read on the third quarter. So this will be interesting to see what we're seeing. But nonetheless, many of the data releases have been surprisingly positive, and the 10-year yield has responded to that. And keep in mind, when the yield comes down dramatically, you would say, gee, the market must love this. Keep in mind, no, you don't want to see yields drop quickly, not on the 2-year and not on the 10-year, because that would be reflective of a scare, an economic scare, that the economy is slowing at a faster clip. So all of this is something that the market is trying to factor in before the Fed meeting, and obviously as we get closer to the actual election. So very busy week on all fronts, from economic data to geopolitics and to the earnings backdrop. And we'll be back next week to discuss the results of all of this. Have a very good week, and thank you so much for joining me.
This material was prepared by LPL Financial. It's for general information only and is not intended to provide specific advice or recommendations for any individual. There is no assurance that the views or strategies discussed are suitable for all investors or will yield positive outcomes. Investing involves risks, including possible loss of principal. Any economic forecast set forth in the podcast may not develop as predicted and are subject to change. References to markets, asset classes, and sectors are generally regarding the corresponding market index. All indexes are unmanaged and cannot be invested into directly. Index performance is not indicative of the performance of any investment and do not reflect fees, expenses, or sales charges. All performance reference is historical and is no guarantee of future results. All information referenced in the podcast is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Securities and advisory services offered through LPL Financial, a registered investment advisor and broker-dealer, member FINRA and SIPC. Insurance products are offered through LPL or its licensed affiliates. To the extent you are receiving investment advice from a separately registered independent investment advisor that is not an LPL affiliate, please note LPL makes no representation with respect to such entity. If your financial professional is located at a bank or credit union, please note that the bank or credit union is not registered as a broker-dealer or investment advisor. Registered representatives of LPL may also be employees of the bank or credit union. These products and services are being offered through LPL or its affiliates, which are separate entities from and not affiliates of the bank or credit union. Securities and insurance offered through LPL or its affiliates are not insured by the FDIC or NCUA or any other government agency, not bank or credit union guaranteed, not bank or credit union deposits or obligations, and may lose value.